Ready to say goodbye to your rental property and cash in on your investment? But the thought of taxes on the sale is leaving like, a bad taste in your mouth. Aloha, Tanya here, Hawaii Homes by Tanya, your real estate professional on the island of Oahu. By understanding the tax implications of selling a rental property, you can minimize the tax bill and keep more of your hard-earned money. From the ins and outs of capital gains tax to avoiding taxes with a 1031 exchange to the importance of cost basis and the benefits of working with a tax expert, I've got all the tips you need to make the process of selling your rental property a breeze. And in just 5 short minutes, you'll learn how to turn those tax headaches into a tax high five. So let's get started. So you're ready to say goodbye to your rental property and cash in on that investment, huh? Here are 4 things you need to know about the tax implications of selling a rental property. Now I know taxes can be so confusing and are never the most exciting topic, but they are important. So let's make this fun, shall we? Number 1, capital gains tax, aka the moneymaker. When you sell your rental property, you'll have to pay a tax on the profit you make. This tax is called capital gains tax, and it can be as high as 20%. Think of it like the government taking a cut of your profit. They want to make sure they get their share of the money that you made. Now, to calculate it, you need to subtract the amount you paid for the property, which is called the cost basis, from the amount you sold it for, which is the sale price. This will give you the amount of profit, which is then taxed. The tax rate will depend on your tax bracket and the length of time you held the property. Let's use an example to make it easier to understand. You bought a rental property for $150,000 and sold it for $200,000. The profit you made from the sale is $50,000. $200,000 minus $150,000. If the tax rate on the profit is 20%, then you would have to pay $10,000 in capital gains tax, 50% times 0.20. And that's how you calculate your capital gains tax. Number 2, depreciation. The tax man cometh. If you've been taking deductions for depreciation on your rental property, part of your sale may be taxed at a 25% rate. Depreciation is like a tax break you've been getting each year, but when you sell the property, some of that break is taken back by the government. 1031 exchange, the tax dodgeball. If you're looking to avoid paying taxes on the sale, a 1031 exchange might be just what you need. This lets you use the money you made from selling one property to buy another property without paying any taxes on the profit from the sale of the first property. It's like a game of dodgeball with the tax man. You sell one property and use that money to buy another property, dodging the taxes. 4, cost basis, the foundation of your tax bill. To figure out how much capital gains you owe, the government will look at your cost basis. This is the original value of the property, including any improvements you made. It's like the foundation of a building. Let's say if the foundation is strong, then the building will be strong. So if you have a good understanding of your cost basis, you can lower your tax bill. Finally, get help, the expert backup. Working with a tax professional or a real estate attorney can make sure you're making the right decisions and help you understand the tax implications of selling a rental property. Think of it like having a coach in a game. They'll give you the advice and support you need to succeed. By keeping these key points in mind, you can make the process of selling your rental property a little less confusing and stressful, while minimizing the taxes you have to pay. And who doesn't want to keep more of their hard-earned money, right? I know I do. So, if you're ready to sell your rental property but want to know more about doing a 1031 exchange, watch this video here.